Hello and welcome to KYC, a show designed to give regular investors powerful, actionable insights into the fundamentals of a single NSE-listed company every day. Well, today we are taking a look at one of the foremost companies in the QSR space, where you just had maybe one or two back then, about 10 years ago. One of them was, of course, Jubilant Foodworks, and I'm talking about the listed space. This one, of course, is known for its Domino's brand. But besides that, it's also come up with a handful of others, over the years. Now, Jubilant Foodworks is actually a part of the Jubilant Bhartia Group, and we do know that the group also does have a lot of interest beyond just quick service restaurants. In fact, this is India's largest food service company at the moment right now, and the group network comprises of around 3,300 odd stores across 6 markets, and it's not just India. Well, the company does cater to Turkey, Bangladesh, Sri Lanka as well, along with Azerbaijan and Georgia. Now, the group has a strong portfolio of brands, which in the emerging markets, and I've already told you about Domino's, which is the most well-known unit of the company, but it also has names like Popeyes and Dunkin Donuts too. And it has 2 brands which would include Hong's Kitchen, which is this particular Chinese brand is not too old. It's been around, but not as long as Domino's has. But besides that, of course, the company is also looking at the cafe brand and coffee in Turkey. So a very, very interesting portfolio of names and brands in terms of QSR, that is quick service restaurants. And now we are going to talk about how the company has done over the past few years, as well as several other fundamentals. So let me tell you about all the things that we are going to address, and perhaps also rate the company. And among the parameters that we are going to, of course, consider is, of course, the income statement, the balance sheet, the cash flow, as well as return ratios. And if we move beyond, we talk about shareholding, street credentials in terms of how the share price is done, valuations, as well as street coverage on the company. And by street coverage, I mean what the analysts are making of Jubilant Foodworks at the moment. As I've already mentioned, that Jubilant Foodworks has been around for a while now, and it was one of the foremost listed companies, listed QSR companies on the exchanges as far as India is concerned. But to shed more light into the fundamentals of the company, I also have with me Mahima Vachrajani. She's joining us, and perhaps you can give us more insight into how things have panned out. Mahima, good morning and thanks for joining in. Let's start again with revenues. I was actually tracking the company where revenues were less than about 400 odd crores many, many years ago. It's, of course, made a 5,600 crores in terms of revenue in FY24. But how does this company look in general?
Right. So in terms of, the 4 metrics of the P&L statement, the company looks strong enough. In terms of the numbers, the 9 months FY24, in fact, is around 6,000 odd crores, and the FY24 number stands at around 5,600 odd crores, and the 3-year CAGR for revenue growth has been 19 odd %. In terms of the EBITDA number, it's grown to around 1184 from 1144. Which was the figure in FY24, and it has had a CAGR of 3 years. Margins have taken a slight hit, but this is because the company has, gone aggressive, pretty aggressive when it comes to the store expansion, which is why the margins are a tad bit under pressure. But net profit has also seen a CAGR of 20%. So overall, the income statement looks good, and even, for Domino's as a whole, the like-for-like improved quite a bit in Q3 FY25. In fact, the QSR as a space, as a whole, has seen a turnaround when it comes to the Q3 numbers. Like-for-like growth, which was negative a few quarters ago, has turned positive and now in double digit. For Q3, for entire Jubilant Foodworks, if I remember correctly, was around 12.5%, which is, quite a significant number when it comes to like-for-like growth for QSR space, which has been muted in the past few quarters.
No, sure, point taken. And we must remember that, a lot of these points will be intertwined with the rest of the QSR space. While we can get an individual point of view on some of these companies, do remember that there won't be a significant deviation in other parameters like same-store sales growth or, well, new store additions, perhaps markets in which they are consolidating, there will be a deviation, but not a significant one. But, we'll come to that. We'll take it step by step. It's going to be a positive as far as your income statement is concerned, as Mahima has mentioned, after the kind of growth that we've seen, about 19% CAGR over the last 3 years. I'll talk about the balance sheet. And at the moment, it does seem like it's in a steady place. The FY24 net worth, that's stood at around 2,200 crores, a little less than that. It does have a debt of around, 1,200 crores, and it does need that much debt, not only for running operations, but also, expansion, which of course gives you and contributes to the top line significantly. As far as cash in bank is concerned, that was also at a healthy level of around 157 crores. And it's the same largely for the first half of this financial year as well. Not too much deviation in terms of your net worth. The gross debt has moved up, but I'm not going to judge the company by that little bit of an increase here because it's mid-year and a lot of these metrics do change considerably by the end of the entire financial year. So overall, we will give this one a thumbs up as well. But Mahima, let's talk about cash flows too. At least those from operations look all right. What about net cash flows?
Right. So, as you rightly mentioned, the cash flow from operations look all right. They're nearly around 794 crores in the second half of FY25, which was around 1,000 odd crores in FY24. Second half of FY25 on the net cash flow basis has turned, negative, but we'll have to wait for the entire year, to get over to find out as to how the net cash flow situation ends, because even in FY24, the net cash flow stood at around 13 odd crores. So it might turn negative, but it might, may not even turn positive because of the store additions that is taking place for them right now. So there's a lot of cash outflow for them right now. So we'll have to wait and watch out for as to how, this second half pans out. So that is one thing. Overall, in terms of the net cash flow, since you mentioned the gross debt as well, that position does not look very nice because you have a net cash flow of around 13 odd crores, but a debt of around 1,200 odd crores. So for that aspect, I think it calls for a neutral rating right now. Which is why that's the only reason as to why cash flow statements is a neutral rating. Otherwise, in terms of operating cash flow, the company looks pretty strong.
That's the point that I was trying to extend, and Mahima has made that very well. That is, your net cash flows will be impacted to a certain extent by the impact of your higher debt. Of course, your cash flows from investing activities will lead to a negative number, or at least a number which will negate all the positive cash flows coming in from operations. So that's another thing to keep an eye on, which is why, of course, it's a neutral rating. But I'll talk about the return ratios. Well, these are tough ones. They don't look amazing right now. So, look, we're working with a thumbnail, the thumb rule around ROE and ROCEs is about 20 to 25% and over, and would be a good, healthy ratio. But as far as the ROCE for this particular company is concerned, it's never been above 15%, and in fact, it's come up quite a bit over the last few years. So, from around well over 15, the mark of 15 is now below the mark of 12%. Look at the return on equity as well. This one was actually super healthy back in 2022 at nearly 25%, but this one has also come off and coming down to around 19%. Return on assets to, again, from 10% to 6%. So there has been a little bit of a decline as far as your return ratios are concerned, which is why we will give this one a thumbs down. But that's as far as your financial statements go. So we've spoken about your income statement, we've spoken about cash flows, your balance sheet as well. Along with that, the kind of return ratios that you in fact tend to see. And based on that, well, this is how things have panned out. But let's look beyond that, and we'll consider how things could potentially pan out for the shareholding. So, Mahima, what kind of observations are you making here?
Right. In terms of shareholding, it's a well-held company. Promoters have not sold their stake. the promoter stakeholding is approximately at 42 odd %. In terms of FIIs, the number has not changed much when you compare September 24 to December 24. But if we see the FII holding from a longer term perspective, March 2022, the FIIs holding was around 32 odd %, which has come down to 21 odd %. So FIIs have been selling, in a Jubilant Foodworks. But DIs, on the other hand, have been, increasing their stake in this particular counter. Again, here where we compare September 24 to December 24 numbers, the change is not much. But if we compare these numbers to March 22, DIs were holding around 15.6% odd share, which has increased and doubled to 30%. So while FIs are selling, DIs are buying this particular counter. And lastly, in terms of public shareholding, the public shareholding stands at around 6 odd % right now for the company, and that is reduced from 10 odd % which was there in March 22. But overall, thumbs up for this particular metrics, because promoters have not sold stake in the company, which means that promoters are positive when it comes to the growth of the company.
Yeah, I just want to make an additional point here in terms of when you consider companies where your promoter holding is not over 50%, you want to look at the stability of your institutions and the kind of the diversified holding that the institutions have. And as far as FIIs and DIs are concerned, that's exactly what you've got. This is one of the reasons why we are giving this a thumbs up, because your institutional holding is considerably higher and your float beyond institutions and promoters is not significant, which will always be and rather bode well for the stock. So in terms of some of the big contributors to the shareholding, we have LIC. We also have, the NPS trust, in fact, which has about 6% stake in the company. Besides that, we have plenty of AMCs as well who hold, good shareholding in the company as well. And again, FII is also significantly there, so which is why it turns out to be a positive. But let's move on and talk about the street credentials as well. What has the company done? So it's a little bit of a mixed one. In year-to-date performance is a tough one. Of course it is, because, well, the entire space is looking at a downturn. We have the mid-cap indexes, the small-cap index, all coming off significantly over the course of the last couple of months. But if you move on and take a look at the one-year return, we haven't seen as much of a significant return on in the last 1 year for the mid-cap and the small-cap indices as the kind of return that you're seeing for Jubilant Foodworks, up as much as 40%, which certainly is not bad at all. I think a little bit of a pain point would be your share price doubling over the last 5 years. 89% return to be precise, so it's not even doubled. Is this a bad one? Okay, so it could be a bad one if you are looking at multi-baggers which have given you a 2 times, 3 times, 5 times, 10 times return over the last 5 years. But if you look at Jubilant Foodworks from the point of view that is giving you steady doubling over the last 5 years, well, it may not necessarily be a bad point, which is why it would, if it was just a 5-year view, we'll give it a neutral rating, but because of the fact that it has significantly outperformed the markets in the last 1 year, it's going to be a thumbs up because of the fact that we were on the fence on this one, and the last 1 year returns have been good. Let's move on to perhaps the more interesting aspect of Jubilant Foodworks, and perhaps Mahima can take us through this one.
Right, valuations. With the kind of up move in the stock, the companies have not been, QSR space as a whole have not done very well in the past few quarters, which is why valuations, don't look cheap for these companies. In terms of EV to EBITDA, Jubilant Foodworks stands at around 37 times, that is 12 months trailing. It'll go to 33 to 27 in 2026. And this is pretty much in line with what the peers are also trading at. Apart from Sapphire Foods, even Devyani International is trading at around 30 times. Westlife Food is also trading at around 39 odd times. Sapphire Foods, on the other hand, is trading at 24 times, which will go to around 18 times, by 2026, is what the Bloomberg estimate suggests. But valuations for, all of these counters, even at 18 times P, by 2026, with the kind of growth that we might see coming in the QSR space, do not look very cheap, which is why we've given a thumbs down when it comes to the valuation picture.
Yeah, I just want to mention that that number, that particular parameter is EV to EBITDA. That's enterprise value to EBITDA. And the reason why we haven't taken price to earnings is because there are a lot of one-offs sort of these QSRs which significantly impacts the bottom line and also, distorts the actual picture, which is why we thought that it would be a better idea to take your enterprise value to EBITDA in terms of valuation. So sure, point taken, valuation maybe not the best at the moment. And I will, conclude with your analyst recommendations. So at the moment, we do have analysts, about 18 analysts who have a buy on the company, but another 8 analysts have a sell on this one. And pardon me, another 8 analysts have a hold on this one and 5 have a sell. So with that, the return potential is not significant at the moment. In fact, a -1 is what the kind of return potential that the consensus throwing up, which means that Jubilant Foodworks is trading exactly where the consensus is expecting it to, trade in terms of its target price. So which is why we'll give this one, as expected, a thumbs down as well. That brings us to your overall rating and how we have, in fact, seen Jubilant Foodworks pan out. So let's bring you all the ratings on that one. And along with that, so we do have a thumbs up for the income statement and the balance sheet, neutral for cash flows, return ratios, not the best. Moving on, we also have shareholding, which is a thumbs up along with street credentials, valuations, a little bit tough, as well as street coverage. Well, not the best. And that brings us to a total of around 4.5 out of 8. So it's crossed the 50% mark. And along with that, let's talk about a little bit more on the sector as well. So, Mahima, we've had a lot of brokerages, analysts coming and talking about the prospects of QSR going forward, especially when you have companies like Zomato and Swiggy changing the game.
Right.
What are you making of this?
Right. So, a couple of brokerages have come out with their view on QSRs, and till now the stance was that, the QSRs might not see a comeback in the next few quarters as well.
Yeah.
But that stance has now changed for a lot of brokerages. They're now saying that, Q3 has been a turnaround for the entire space.
Yeah.
To name a few of these brokerages, Morgan Stanley came out and said that the pizza category same-store sales growth has turned positive. They're saying that Jubilant's growth trends were ahead of its peers, which is why they remain positive on Jubilant. And in terms of inflationary headwinds and competitive landscape, they kept the margins in check, but they are within the guided range. Now, in terms of the same-store sales growth trends, they improved sequentially, while average daily spends remained weak overall. And net store addition pace improved, but the demand outlook right now is a bit cautious. Goldman Sachs has said that QSR players are now gaining share within the food delivery market. This is a very interesting one because what they said is that the growth gap between QSR sales and aggregators' gross order value has been narrowing down. So this is a very interesting observation that Goldman Sachs has made, because this is what will probably, augur growth for QSRs in the next leg. And in the delivery channel, they're saying that the QSR players have gained market share overall in Q3. Dine-in channel seems to be recovering, which is a positive again for these QSRs because they've been expanding in terms of, the store additions as well. And yeah. Bernstein as well. And, we're going to talk to Jignanshu Gore as well. In a minute. Yeah. He's also, given different ratings on, all 4 of these. But yes, Agam, as I rightly mentioned that, QSRs are seeing a turnaround when it comes to
Yes. So let's take this conversation forward with, in fact, Jignanshu Gore. He's he's with Bernstein SocGen Group. Jignanshu, good morning and thank you so much for taking the time out. Firstly, I start with my question on Jubilant Foodworks itself. Your assessment, only as a standalone entity. We want to talk about the QSR space, but how are you looking at, the prospects of Jubilant Foodworks based on the place which it is in the current environment?
Thank you so much for having me. I would look at Jubilant Foodworks and break that business down into 3 big parts and look at those 3 parts individually to sum it up. Part 1 is the Domino's pizza business, which has tailwinds of pizza as a category, has tailwinds of competition which has peaked in the past. So the competition for Domino's was from Pizza Hut, which is the second largest pizza chain, which has struggled, and it was from the local regional pizza chains, which were being facilitated additional competition. So we think the competition has peaked in the past, and they have reported great numbers on the pace after that competition. So they have also significantly added growth stores. Close to 180 stores is what we expect them to add in FY25 and continue that going forward, because we believe there is potential for Domino's to add good stores. So I think as a category, it has tailwinds. Domino's also has really changed their business model with the changing landscape better by reducing the number of stores and having a strategic advantage for delivery, which is where the pizza consumption is shifting towards. So we expect Domino's margins to be much higher than what their peers at, let's say, Pizza Hut or KFC are able to deliver, which should drive support the growth for Jubilant numbers as well. The second part of the business, which I think is a drag today, is the other brands in India, like Popeyes or Hong's Kitchen or Dunkin' Donuts. They are building these brands as they continue to build them over the next few quarters. We should see increasing numbers there. We think the biggest part of the business, which is least understood, is the Turkey business, given the kind of upheaval on economic or on currency there, and the very volatile numbers that we've seen. I think these three is how I understand. So very positive on Domino's, neutral on the other part, and neutral to positive on Turkey.
Okay. Jignanshu, very good morning to you. I just wanted to understand, in your note, you had said that, you expect second half to be much better for QSRs as compared to first half. And we've already seen that happening in Q3 itself. But one counter that you're not, bullish about is Westlife Food. And in Q3 also, as compared to how the other three have performed, that is Devyani, Sapphire, as well as Jubilant, Westlife has not done well. What is your view with respect to Westlife Foodworks? Because I want to understand what is happening exactly there. I mean, are people not buying McDonald's burgers anymore?
I don't think that's the case. Mahima, glad to be here. My view on Westlife is because there is a structural disadvantage to that company, given their business model for burger category is focused on dine-in, whereas in that price point, majority of consumption has started to shift to delivery. So a business model which is built for a dine-in will inevitably have larger fixed cost structure, which is more rigid. You cannot change that with demand. And you have a larger capex because your store sizes are also larger. Over the course of this year, though, I expect that given the base that they have last year, which is very low, recovery in demand due to general consumption sentiment should help their margins also to improve. Today, Westlife stock trades assuming that they will be able to meet their F27 vision targets. And Westlife is probably the only company which gives a detailed guidance for a longer term. We expect meeting those numbers to be challenging, both on store additions as well as on what is called average unit volume or AUV, revenue per store per year. That should then create a struggle to flow down through PAT as well. So I think it's slightly business model concept issue versus anything in the industry, which is why, relatively speaking, we prefer the execution model of Domino's versus the execution model of Westlife.
Okay. So, Jignanshu, if you just take the entire QSR space right now, there are companies which are profitable, there are companies which are significantly profitable, and then there are companies which are still struggling with, not just their bottom line, sometimes even their operational numbers. How are you rating companies what is your priority in terms of the best and those which are not in the best place?
Out of the 4 companies that we cover, my pecking order would be Jubilant, Devyani, Sapphire, and Westlife in that order.
Okay.
Jubilant, I think, has the most near-term catalysts in terms of margin expansion. Yeah. Okay. And hence, that's my topic.
All right. So then a follow-up here. A lot has been also spoken about the role of your quick commerce companies are playing right now, your delivery companies are playing right now and changing the landscape for the QSR space. What is your reading of that particular aspect and the kind of impact it is having on the QSR segment?
There are 2-3 ways to look at that, and we can read across from what we see on Zomato and Swiggy numbers. One, they are definitely shifting the consumption pattern of customers to delivery. And all QSRs in that price point need to cater to delivery as a channel, and hence keep their products ready for that. It's stronger than QSRs for the last few quarters. If you look at a critical metric of the order that Zomato or Swiggy generate per restaurant that is there on their platform, that number has been trailing negative for the last few quarters. So they are adding a lot more restaurants, which is leading to growth. But individual restaurants on their platform aren't necessarily growing on their platform. What this means is that QSRs have a fighting chance because of their brand, and the competition from aggregators has peaked. With these two in mind, companies who can generate demand by their own platform channels, so Jubilant generating demand on its own application, McDonald's doing the same, have a better chance of competing against aggregators today. I think the latest thing I want to talk about is the whole 10-minute food delivery. I think that is also a very net positive for QSR brands because it is unlocking a delivery category which was so far restricted to local canteens, cafes, or roadside stalls. I think that can become organized with a 10 to 15-minute food delivery. And once that happens, the QSRs who have the best kitchen processes to reduce the preparation time will be better off versus QSRs who take a lot more time for prep. So again, Jubilant works really well here. And in fact, even McDonald's, they can offer a much larger menu for the 10 to 15-minute snack. And it unlocks additional TAM, which was not available to them or to food aggregators.
Okay. Well, you know, we have a ton of questions for you, Jignanshu. Unfortunately, we're out of time. We should have gotten you in sooner. But, you know, that is all that we have for you for now, at least. So thank you so much for joining us and talking to us here on NDTV Profit.
Thank you so much for having me. Cheers.
Well, there you have it. So that's the Bernstein view on the QSR space. And of course, Jubilant Foodworks, Jignanshu is positive on that particular company. But on that note, we are completely out of time on this show. That is all that we have on KYC, but don't go anywhere. Lots more lined up on the other side. You're watching NDTV Profit.